Assalamualaikum. My name is Nur Nabila Huda binti Muhammad Kamal.
Hi, my name is Najia Karim.
My name is Raidah Adibah binti Hasim.
My name is Nurul Izzati binti Zainal.
My name is Nur Izzah binti Ibrahim.
They have three forms of EMH. First, weak form EMH, that is, suggests that all past information is priced into securities. Second, semi-strong form EMH, new information is instantly priced into securities. Third, strong form EMH, all information is priced into stock and that no investor can gain advantage over the market as a whole. Stock market is the capital market in Malaysia since the 1960th century. There were only 2,052 companies listed on the KLSE and served by 53 stockbroker firms. One of evidence against EMH in Malaysia is non-linear behavior of stock price. First question is, what is EMH? What does it imply for the performance of mutual funds? EMH information is reflected in price immediately. Investors should only expect to obtain a normal rate of return at efficient market. Stock always trade at a fair value on the stock exchange, making it impossible for investors to purchase undervalued stock or sell stock for inflated price. The only possible way for investors to obtain higher returns is by purchasing risky investment, while for firms, they should expect to receive fair value for security that they sell because in efficient capital market, no available valuable financing opportunity arising from fooling investors. Okay, next, based on our understanding, have 5 premises for EMH. First, security price reflect all available information concerning a firm. Second, security prices fully incorporate known information. Third, price change rapidly to known or non-known information. Fourth, information disseminates rapidly. Lastly, day-to-day price change will follow in the random walk over time. Random component in the current period is unrelated to the random component in past period, which means no predictable for the past price. EMH cannot make abnormal return in an efficient market due to implication on mutual funds because stock price have fully reflected by information release. This means that information release does not affect the stock price since that is fully reflected before.
Consistent with the efficient market hypothesis, mutual funds also do not beat the market. Not only do mutual funds not outperform the market on average, but when they are separated into groups according to whether they had the highest or lowest profit in a chosen period, the mutual fund that did well in the first period do not beat the market in the second period.
Second question is, briefly discuss capital market event and anomalies exposed by empirical research that were inconsistent with the view of market as fundamentally rational and efficient. There have 6 types of anomalies. First, limit to arbitrage. Second, earnings surprise. Third, size. Fourth, value versus growth. Next, crash and bubble. Lastly, temporal anomalies.
Efficient market hypothesis assume that whenever mispricing of a publicly traded stock occurs as a result of an overreaction to news or some similar event, an opportunity for low risk profit is created for rational trader. Arbitrageurs will go further by buying underpriced security and selling overpriced security. Based on Royal Dutch Petroleum and Shell case, their limit to arbitrage mean that an investor will buying the overpriced asset and selling the underpriced asset. According to the Jones Maynara Keynes, said that markets stay irrational longer than you can stay solvent.
Earnings surprise EMH implies that stock price will be always adjusted immediately after the announcement, which means the stock price would be increased if the announcement have a good news and vice versa. However, there is a contrast behavioral challenge where it predicts another pattern. Based on the study made by Kolasinski and Lee, the price adjusts slowly to the announcement due to the conservatism behavior, which people are too slow to digest information and adjust their beliefs to the new information.
There is an example of capital market events for size. According to one of the earliest anomaly study, R.W. Burns in year 1981 stated in his research that smaller company stocks generate higher returns compared to larger company stocks over long periods of time, which means that smaller company stocks perform better. Since 1926, smaller company stocks in the United States have produced higher rate of return by 1% over the return from large company stocks.
Capital market events for values stocks appear to provide higher rates of return than stocks with high price to earning ratios, as first shown by Nicholson 1960 and later confirmed by Ball 1970 and Basu 1977. This finding is consistent with the views of behavioralists that investors tend to be overconfident of their ability to project high earnings growth and thus overpay for growth stocks. The finding is also consistent with the views of Graham and Duke 1934, first expounded in their classic book on security analysis and later championed by the legendary United States investor Warren Buffett. Similar results have been shown for price or cash flow multiples, where cash flow is defined as earning plus depreciation and amortization.
The view of markets as fundamentally rational and efficient are at odds with the mispricing that drives economic bubbles or crashes. Referring to the Black Monday that happened on October 19, 1987, the stock market crash was rapid and had a severe dent in stock prices, which was affecting the stock market around the globe. The DJIA fell in a record of 22% on that day alone, with many stocks halted during the day as order imbalances prevented true price discovery. An example capital market event and bubble that is inconsistent with the view of rational and efficient market is Bitcoin. It keeps on rising despite numerous predictions of its demise, or how Bitcoin is just a flash in the pan. In late 2013, when Bitcoin surged from $100 to $1,000, many experts call it a bubble. But Bitcoin was pricing in growth from China and increased adoption, which later came to fruition. And that's why Bitcoin is at $600 now, having retained most of its gains from 2013 because the fundamentals were real.
Okay, the last type of anomalies is temporal anomalies. That means calendar in fact bring into question weak and semi-strong form efficiency because return on market are not random but predictable based only on calendar event. capital market event for this type have happened in Malaysia. On the daily closing value of Bursa Malaysia Composite Index over the period on 2 December 1993 to 10 October 2003 found that there is evidence of negative Monday return in post-crisis period on February 1998 until October 2005. However, this study found that there is no evidence on January impact or any other monthly seasonality. Monday impact is mainly based on stock that not have a higher percentage of institutional ownership. Last question. Assuming that the MAH hold, how will you respond to Larry's ability to consistently outperform the market? And do you agree with the claim that Larry's success is luck?
There is a theory called efficient market hypothesis created by Eugene Fama in year 1970s, and it is stated that impossible to beat the market or outperform the market because stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. According to this theory, stocks are always correctly priced, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. It is also impossible to outperform the overall market through expert stock selection or market timing, and the only way an investor can possibly obtain abnormal returns is by purchasing riskier investments. T. Rowe Price Blue Chip Growth Fund invests primarily in large capital US stocks with above average growth prospects. This fund implemented active portfolio management where fund managers buy and sell stocks with an objective to outperform an index fund, such as Standard & Poor's 500 Index, or usually called as S&P 500. The success of this actively managed fund is dependent on combining market forecasting, in-depth research, and the experience and expertise of the portfolio manager or a management team. Portfolio managers, just like Larry J. Paglia, engage in active investing the market trends, shifts in the economy, and other factors that may affect. This information is then used to make the purchase or sell of investment at the right time in an effort to make abnormal returns. Actively managed funds also take additional market risk to beat the market because the higher the risk, the higher the return in order to compensate the riskiness of the investment. While for index funds, they tend to eliminate the risk as there is no risk of human error in terms of stock selection. In this scenario, the average annual return of T. Rowe Price Blue Chip Growth Fund is 10.12%, which is outperforming the benchmark, 9.12% for the Standard & Poor's 500 Index, or usually called as S&P 500. In theory, as we have seen, it should not be possible to beat the market. However, empirically there are examples of market-beating performances. A different perspective and notion that has been more prevalent in academic literature is that without investors trying to beat the market will not be efficient. Intuitively, this does make sense. Price changes are driven by information. The more information you have, the more efficient it is. Therefore, the market needs investors to think that it is possible to beat the market. However, we do not agree with the claim that Larry J. Paglia's success is based on luck. Based on the test conducted by Forbes magazine, they stated that the rate of return of the portfolio is 9.5%, which beat the broad market averages. But the portfolio is randomly selected from the list of 1,000 stocks are bounded to include smaller company stocks. Since many small companies outperform big companies, this is how the portfolio beats the market, by using randomly selected. In my own opinion, in order to beat the market, the investors must have some special skills, observe the pattern of the stock price, and many more. In other words, it will need a lot of effort to beat the market compared to solely relying on the luck. Larry G. Paglia's team has so many talented portfolio managers that can search for information and observe the market in order to beat it. In the real world, there are so many investors that do not have any skill to invest and just rely on their luck and end up losing all of their money. Besides that, T. Rowe Price Blue Chip Growth Fund is a large capital growth fund, whilst S&P 500 is a large capital blend fund, which is a hybrid fund, a combination of value and growth. Even though the growth stocks are much more expensive due to expectations from investors of higher sales or profits in the future, so expect high price to sales and price to earnings ratios, and riskier, it tends to make a larger return due to theory of the higher the risk, the higher the return. Thank you.
In conclusion, EMH is a theory assumption that no investor is able to generate an abnormal return in the market. An investor can expect to make a return equal to the market return. An investor should then focus on minimizing the cost to invest. However, based on the case given, in which the company can beat the market and make an abnormal return, another theory also stated that the higher risk will sustain a higher return. So, the investor also needs some special skills, such as observing the pattern of the stock price and many more. The special skills are important because we cannot believe on purely luck to the investment.
That's all from us. Thank you.